Hello, my name is Dr. George Machaki, and welcome to International Finance. This is in your course catalog, FIN 225, International Finance. This is going to be an overview of what this course is about. Not the homework assignment, just the different chapters you'll be reading. The prerequisite to this class was Management 217, I think, or Finance 217, because they had some changes. That was Introduction to Finance. You've already had Accounting 101 or 102, so you already had those two levels of accounting. You had Introduction to Business, most likely. If you're not, you will. But the prerequisite for this one was, what do you call it, Introduction to Finance. So you already have the concepts. You already know you've already been uh, exposed to BA2 Business Professional Financial Calculator. And if you haven't, I would purchase one. If or you could be using your Texas Instrument scientific calculator if you know how to program in the different formulas. Works well for finance. But usually when I've taken finance classes at the bachelor level, as a master's, even at the doctoral level, I'll just use the same calculator. It hasn't changed any. It already has the formula. It makes your life easier. Okay, so you've had that. You've also had hopefully if you've taken intro to finance, you should at least had accounting 1 and accounting 2. So you're already used to the ratios. You're already used to the different profitability, your liquidity. You're already used to some of the terminology. You're used to future value and present value of the dollars. You're used to amortization. You're used to annuities. You've already been exposed to a lot of either utilizing tables, the calculators, or utilizing an Excel spreadsheet, whether it was in accounting or in corporate introduction to finance. You had to have those basics understanding. So now you have the understanding, even though you may go, man, I don't understand all this. Now I'm going to add on a whole additional icing, the way I would look at it, to what you already had. When you look at this international finance class that you'll be taking, we will do some math. You'll be using Excel spreadsheets, and when you use the spreadsheets here, when I open the spreadsheets for you, I'll allow you to use the spreadsheets. A lot of times the formulas already be embedded, so people say this easy, just plug in the numbers. Yes, but I want you to understand how they set up the formulas. Okay, so you'll do that, and through the author there's a link. I think if you brought a new book, the link goes real quickly. I think the books was you could rent this book here. I think it was a rental book. I still think you could get the link because I think the passcode wasn't really that expensive. To rent it, it's $148. To hardcover rent, option U was $214. You get it to December, or you could buy a brand new one for 330. It looks like this one. Here's the cover of it, and it's the 12th edition. Jeff Madra, easy reading, good information, give you good basic. I think this was the same one, if I'm mistaken, for your introduction to finance that you've taken here at Harper or another institution, and you're just saying, hey, they're offering it here, and I need it for my degree someplace else, and this course is a transferable course. Okay, so what do we have here? Now, what I'm going to go through here, remember, you're going to do some math. You're going to be required to do some math, do some spreadsheets. But my main focus is not as much as to the math as for you to understand the different concepts, the strategy. When you're looking at, you already understand the strategies and the concepts for the U.S. market. Now what you're going to do, you're going to go into the international market. And when you look at the international market, you talk about exchange rate, everything else. It's a large market, a lot of countries. So what we'll try to do, we'll focus in on one. You'll be doing a paper, a term paper, looking at a multinational organization or creating one from a financial perspective. How do I buy it? Either buying through debt financing, that's equity financing, but in another country as a direct investment, as a team. You'll be working as a team, and there'll be the handout. There'll be projects going forward, or you'll be working on a term paper after chapter 1. Look at some term paper with a team. I haven't, it depends on the size of the team, and it depends on what basically the class needs for that to not only learn the new concepts, but be able to apply what I've learned in some kind of a tangible product. Okay, so you're going to learn now, like I said, the whole thing is now you're going to take, so you understand how to do it domestically. Now, even accounting, they talked about the international accounting, what do you call it, initiative going in there. So, because a lot of business are multinationals or they have operations in different countries, and so they want a standard accounting rules, just like you have the acceptable accounting rules here domestically. They want what are the international rules. So the international rules basically follow in line for domestic, so there'll be all one rule. So if I'm doing here in the United States, or I'm doing in China, or if I'm doing in another country, if they're in the international market, the global market, we all will have the same accounting procedures, the same template. So when I'm looking at profitability in one company in one country, I could look at it in another one. I mean, but the thing that's going to be different, even though it's going to be set up this way, what you can learn in international finance is the exchange rate, the value of that currency. And and sometimes you may have the operation. We've talked about, you've heard about inversions. A lot of U.S. companies, national companies, are changing their headquarters to overseas or merging with another company as to avoid the high tax rates here, but going to another country where the tax rates are lower, but still doing business within the United States. No different than if I've incorporated in Illinois, but I could work anywhere in the United States. So when you look at a global corporation, multinational companies, and you've learned that in the introduction of business, you've learned that in finance and other things, like concepts out there. So when you look at them, they're looking at the world as a flat economy by Friedman. Flat economy. The world is one global economic system. So it doesn't matter what I'm doing. Economically, it makes sense for me to go someplace where my tax rates are lower. Because my tax rates are lower, I could have a higher return on my margin, or I open up a production line or distribution in another market, maybe in China, because that's where I want to capitalize and expand in that market. So how do I convert my dollars into the yen currency, or vice versa, and how do I go in exchange, or do I just stay there? Or a lot of times what you learn is, when do I bring my money back to the United States, or where do I leave it there? The United States economy is slower, that's growing, so maybe I'll invest more. I'm looking total, I'm looking at a portfolio, but from an international perspective, the whole world. And so I have to, what I've learned here domestically, still finance and everything else, now I have to tweak it or look at it just a little bit different. I'm adding a few more applications, a few more line items, for lack of a better word, a few more what do you call it, the financial formulas added to what you already did, the exchange rate or the buying, or when do I transfer money back and forth. So all that is really something that I'm looking for. Okay, so we're going to go with this. So when I'm looking at this, look at this from the perspective, it's going to be mind-boggling, but don't freak out. We will cover, my job here in this introduction class is to give you a good, solid base understanding on international finance. Okay, so the book is divided into 1, 2, 3, 4, 5 sections. And under each of the sections, you have a variety of chapters. What I'm going to do now is just to understand, what am I getting into, what's in here. Again, mine is to give you an introduction class. There's a lot of concepts, a lot of definitions, a lot of new terminology. There's math in there, but I'm going to more focus on taking you on strategically to think as an international finance manager or management looking to do business overseas, or either exporting, importing, or investing, or opening up a facility, or whatever. So you have a general understanding. Okay, so don't worry, you'll do well. We'll get you through this. You have some math, we'll have the quizzes. Everything will be set up I utilize mind maps like this. I try to have them for some of the more key chapters. You have the Excel spreadsheets. We'll work in teams, so you'll learn this just like you would be in the corporate world, and you have to learn. So take this as a learning. This is just a quick overview. You know, if you purchase a book, I'm just going to go over so you understand what we will cover. There's no way I could cover everything you're going to find out here. There's 21 chapters to cover everything in such detail. Mine is just to give you a basic understanding how the different parts. You're not going to remember it all. You'll take other classes, another international finance, another maybe international accounting or international managerial accounting, and after a while it all clicks. It's not that hard. It's just adding on. You've got the basic understanding from your accounting classes and your introduction to finance with the math and the calculator. Now let's just add it up one level. Look at it as accounting 101, and now you're going to accounting 102, or you've already taken accounting, finance, 217, and now you're going to take finance 225. Okay, so let's look at it. I'm just going to go quickly. Shouldn't be more than half an hour. I will have a whole another a recording specifically for the chapters. I'll try to do that for the important ones, maybe not for all of them. And then I'll also have, if you're taking me online, an introduction explaining what's required with the forms and the homework and how that's all transmitted. Okay, so let's look at that. Our first chapter, so we're going to do international financial environment, just to give you a general idea. So we're going to talk about multinational financial management, international flow of funds, international financial markets, exchange rate determinations, and currency derivatives. Now, some of this you already had in your classes. You've had it in finance, you've had it in into the business. So if I'm looking at multi-financial management, what will be covered is an overview of everything else. Your first chapter is basically an overview. Managing multinational corporations, why firms pursue international business. I'm not going to go into a little more detail. How firms engage in international business. And you already had this. Let me just go on here. You already had international financing. If you had introduction to corporations, or if you had marketing or anything, you already know some of these terminologies. So you have a baseline. We're just building on this baseline. Acquisitions, establishing, even though not to the length you're going to go in here, but it just gives you more. Okay. And the same thing when I'm looking at this one, why firm purchase, comparative advantages, and we've had that into the business or into, and I know if many of you had the classes as a prerequisite, whether at this college or other college, imperfect market theories, product cycle, management, marketing. If not, this would be a good exposure. You've had discussed some of that in your finance classes. Okay. Now, international, chapter 2, international flow of funds. You're going to talk about the balance of payments. Okay. Current account, capital accounts. Yeah, remember, these are terms. I'm planting the seeds now. Growth of international trade. Events that increase trade volume. We have a big deficit in the United States. We import a lot. We don't export more. So how can we do it? How can we do something that's going to keep the companies, multinationals, still stay in the United States? We don't want to overtax them, but we want to be make this situation, this environment look favorable. So trade value among countries, impacting outsourcing trade, trends in the U.S. balance of trade, factors affecting international trade, impact of inflation, and inflation, how does it affect us? You got global inflation, you have domestic inflation, you have foreign inflation. Some countries, Brazil has a high inflation rate. If you look into Greece, they're out of the market now. The currency's nothing, but they can still survive. Look at them, a bankrupt. I start off from nothing. What do I got? So they'll have to make it, but it'll be a little bit rough. But maybe that's the best thing. Get out of the euro. But that's something to find out. Let's discuss that. See what they say. Impact of exchange rate. What's my dollar worth? When do I bring the dollars back home, and when do I leave them or leave them to invest? Which one gives me a higher return? Right now the interest rates are going up. Okay, so now I can maybe invest back into the stocks and bonds here in the United States. When they were low, it wasn't worth it. Okay, interaction factors, and how we interact. You have the IMF. You have different organizations out there that's already doing a global e-commerce or a global commerce. Now we are looking at how we do the finance and accounting and work with them. There is like a an acceptable practice, and that's what you're going to learn here. International capital flows, factors affecting direct foreign investment, what tax breaks do I get? Could I be an owner? Do I have to have the government involved? Depends, how credible the country is. Affecting international portfolio investment. I have different countries, some are similar countries, and overall, I could be a financial manager. I am a financial manager. How do I improve my portfolio? Or if I'm buying a portfolio, how to become a part of that portfolio for someone else? Because, if I'm going to buy my stocks or buy my bonds, if I'm a corporation, a multinational corporation. And the impact of international cash flows going back and forth. Okay? Now, international financial markets, remember there's different markets that have it. Foreign exchange markets, history of foreign exchange, transactions, quotations, interpreting foreign exchange quotations, currencies, derivatives. So when I'm looking at this, what's the currency worth, what is it derived for, what's it backing? Some still have some gold, saying very few, some has silver, some metal. U.S., our currency basically is derived from In God We Trust. That people still think we're strong. I'm only joking, but I'm just trying to bring that in. It's just something you're going to learn. We'll look about this, okay? International money market origins, money market interest rates among countries. What's the different rate? Remember, I'm moving money back and forth. It's like I have money in which account where I put it, because the world is one big global. And a lot of times you're going to find they'll move it all over. They know a country, they get familiar with a certain market or a certain foreign exchange and anything else, and they'll stick with that because then they learn it. You could go everywhere, but if that's shaky, where do I transfer? So I have to relearn it. Because after you know the markets and everything else, it makes it easier for finance. So when you're looking at it, don't let your head spin. Once you go international, the same terminology, but you'll be focused on that country and you'll see it and you understand how the market or the value fluctuates. Okay, international bond markets, Euro bond, development of other bond markets, bond yields, how much it's going to cost me by the time I get it back, yields of farmer, term, but it takes everything, the cost, the interest, everything, the time, that's all part of it, and then what's left over. Okay, risk of international bonds, and again, impact of Greece crisis bonds. Right now, they're in or not a euro, they're making up the last minute, but we'll see what happens. And there'll be something current, because a lot of times with the author, we'll go look at onlines that are current. Okay, international stock markets, issuance of stocks in foreign markets. How do I do it? You have Japanese or Chinese companies are going into here, actually selling the stocks within our market. How do they do it? How do we go and sell our stocks within their markets? What are the rules? What are the regulations? There's a lot. It's just some things for you to think. Okay, what works out here, how do we do it there? Okay, you're just thinking. Issuance of foreign stocks in the U.S., and investing in foreign stocks, okay? How financial markets serve a multinational organization. One thing you learn, multinational organizations have no loyalty to any country, because the whole world is one big country to them, one big world economic system. Okay, now exchange rate determination. There was a lot of things going on there. I'm not going to go through there's a lot here. And only in chapter 4. Exchange rate determinations, measuring exchange rate movements, which ones are moving, for a few seconds, I got $1 million, I can make some money on that, and a lot of that is like a robocall or electronic. They're looking at, is that legal? Does that give an unfair advantage for people who have those supercomputers? Exchange rate equilibrium, demand for the currency, our currency, supply of the currency for sales, and what's the equilibrium price, and when do I buy, when do I sell? Just to think about. I'm giving you a lot. Don't let your head go. There's a lot of terms. This is what is a baseline. It's like when you've taken Introduction to Management or Introduction to Finance. We start with all this information. Afterwards, you have it. Now I'm just adding more to it. A lot of the stuff you already have, I'm just adding a few more steps into the formula, but start thinking strategically. You still have to think globally as a business owner. Work globally, act globally, think globally, but also think internationally and act internationally. You have to be in both arenas. Okay, factors that influence exchange rates, like anything else, relative inflation, interest rates, income levels of individuals, expectations, interaction factors, influence factors across multiple currencies. Something could have happened, some kind of war or some kind of effect, some kind of natural effect could affect the market when Japan's financially when they had the earthquakes and the tsunami in there that affected the markets for a lot of things because they didn't have any replacements. So financially, how to move money, what happened slowed me down. I should have been aware of it, and a lot happened. A lot of people now have alternatives if something would happen if I'm tied into that market and something happens. Okay, and movements across exchange rates. Explaining movements across exchange rate. Why is it movements? Remember, part of finance and everything else. I'm looking. What's the trend? What's going on? Which way do I go? What makes sense? What's going on? So I could be proactive, not reactive. Okay, anticipation of the exchange rate. We're all listening to see what the Federal Reserve does. The IMF is basically saying, National Monetary Fund is telling the Federal Reserve to slow down. It may have an economic recession worldwide if you open up too quickly. Your currency is there, whatever. You're all right. We'll talk about institution speculation on expected depreciation, speculation by individuals, and the carry trade. These are just concepts. It's not hard. Remember, you already signed up for the class. You already brought the book. Let's just talk about this, okay? Let me just close all these off. I don't, I'm running here. I'm looking about usually my lectures on every chapter if I have them about an hour. You got the book, you got the resources, okay? So currency derivatives, forward market, how everything is basically looking at the corporate multinational organizations, how they move. You've had introduction to finance, which is corporate finance. So you understand how local, domestic, U.S. businesses operate. There was some little finance, international aspects in there in every chapter, but not to the extent you'll be in here. Now you're taking it to the next level. I'm a multinational a subsidiary or business or headquarters, or I want to be multinational. How do I utilize play in the financial markets? Because my markets and my customers are outside my domestic domain, but what we would call in the global economy. Okay. So forward market, currency futures, trading, comparison, pricing. He goes, holy jeez, these are all terms. Look, don't freak out. There's a lot of definitions. There's a lot of concepts. You'll do well. I'll set it up. You'll have these. But I want you to remember, you just have to be exposed to this. You can't remember all of this. I know, I'm not, come on, I'm not, but it's everything else is like, here's all the parts. Let's just talk about. A lot of these things will tie in together, or they'll tie on here. Remember, I can't cover everything. I'll pick up what's important for the chapter, what's important for your thing, but you have the exposure. If you're going into finance international, I would keep this book. It's a good book. It has a lot of information, a lot of terms. You're going to talk about the currency call options when I call it back, on premiums, currency, how the firms use call options, speculating currency, and then you have put when I sell it, put option premium. So you have hedging, one's buying, one's selling, and you'll find out which is the difference when you read the book. And the book is fairly easy. It's not that bad. The formulas that people get a little freaked out, you do fine. I'm looking more for conceptually so you understand some of the terms, at least the big ones like this, okay? And contingency share graphs and conditions for currency options and European currency options. When do I buy, when do I sell? All right. So that just took care of, part one. I'm going to go real quickly in part two. This one we're going to talk about government influence exchange rates, chapter 7, international average, and interest rate parity. One is when I buy it and how do I compare it to the cost of economic goods, and we'll do good. Right? Just pick it up. Remember, it's a concept that's utilized more in the international finance. You'll do fine. So let's do chapter 8. A relationship among inflation, interest rates, and exchange rates. And on this one here, I'm looking at different exchange rates, government intervention, exchange rate systems, single European currency, how does that work with the Eurozone? All right, government intervention as a tool policy. When does the government intervene? The government intervenes a lot. Fixed exchange rate freely. In China, they opened up their stock markets there, went down. They were propping it up, and I don't think the government should involve. Let the market fall down and let the investor pick up. But they didn't want to fall down because they're open up markets, so they're assisting. No different than we did when our market was crashing. The government placed money in it, brought out some of the larger banks and tried to bring it back up. So the financial system was stable. Remember, our system would crash, it would affect the global, international. Another system crashes. If Greece kind of part of that, if they went under, is it going to affect the euro? Will it be a ripple effect if people invest all over across the financial global market? All right? Dollarization, single currency we'll talk about in the Eurozone. Okay, exposed countries with the Eurozone. Government intervention, again, reason for government intervention, direct intervention. They come out, their laws are indirect. They do things, something with the market, try to stimulate it so they don't look like they are adjusting a free market. Okay, now chapter 7, we had that. Okay, so I must have jumped. International average, location, triangular, cover, interest rates. Okay, we'll talk about interest rate and parity. Variation of interest rate parity, determining forward premiums, graphic interest rate and parity, test interest rate. You'll know everything you want to know about parity. Well, what is parity? You'll find out when you read the thing that we get in here. Okay, variations of forward rate premiums. Again, forward rate across maturities, when did it mature? We talked about certain bonds that come at matures. We talked about certain obligations that we have to pay, or IOUs in finance, and now we're going to look at this, the same thing from an international perspective. Okay, and the last one, relationship among interest rates and exchange rates. It has a big difference. Purchase power, parity. Remember, when I transfer one from another, do I give them in the U.S. dollars, or do I transfer it to equivalent to what the economy would be there? Otherwise, you have people that are working, especially multinational, and it's a little concept. Once you understand what they're doing, it makes sense. Because if I'm giving them exactly, let's see, $120,000 for a president or some kind of a manager here in U.S. dollars, and he goes into a country, a developing country, and their exchange rate is really it's like triple there. Is it fair for the person working there, or do I pay him with equivalent to what that currency would buy there, and when they come back, same versus here, so they don't have this big jump like a millionaire and then come back to poverty, for lack of a better word. So, and we'll explain that a little bit more. Okay, so don't worry about that. That's how much I could purchase, and it has something to do with depends on, it's like a cost of living if I'm going to New York, but more on an international scale. Okay, so I could add it on and then take it off later on. So it's not like I give him a raise, but his cost of living is adjusted either way. Okay, and the Fisher effect, and we'll talk about that. Okay, and so if you don't know it, doesn't make it. How do I international Fisher effect? How do I for the investors look? How do I measure it? Okay, and we've had that in finance, so we're just expanding on that. All right, so we have this. Now we're going on part 3. So this was exchange rate behavior. How do I exchange money back and forth? Okay, you need that in finance. Internationally, this one is just different funds, different markets, different rates, and currencies, derivatives, what the what's backing them, for lack of better words. Gross national product or gross domestic product. Right now, we're going to go to gross national, which also includes the international aspect and most of the GNP versus the GDP to take out the international aspect of different companies working in there. Okay, so now you've got the exchange rate risk management. Ooh, that sounds pretty good. We're going to talk about forecasting. Is it part of financial? How do I forecast? Where do I move my money ahead of time, before, so I have it available, or when I pull it out when I think something's going on? What's the exchange rate? When I bring it back, do I need it now, or can I hold it off and get the best exchange rate? Okay, why from forecast exchange rate? Different techniques you're going to look at. You have the technical forecast, fundamental, market-based forecasting, mixed forecasting, guidelines you're going to talk about. There's always a mixture. Forecasting errors. How do I adjust for an error? This is a mathematical formula. I just want you to understand you should adjust depending that there's going to be some error. Remember, you're forecasting. You're taking your best guess, but you have to put some factors in there. What are some forecast bias? Where am I getting information from? Graphic evaluation, performance, comparison of forecasting methods. Which one works well for this market, and which one works well for that market? Some are better than others, depending on where to get the data. Some of the data in international finance you can fill out. A lot of countries aren't very transparent, so you have to make some assumptions. Sometimes you're better than others. Okay, and forecasting and the market efficiency. All right, using interval forecasting, exchange rate, vital it is. I mean, is it really going up and down? Or is it calm? The vitality of the exchange rate. All right, so we'll close that down. Okay, chapter 5, measuring exposure to exchange rate fluctuations. Relevance exchange rate risk, transaction exposure, economic exposure, translation exposure. So there's just different terminology. What's happening in the fluctuation, so I understand what's going on, so I could read it, so I don't jump the cell or jump the gun too quickly. Okay, and this one just when we talk about that, estimating that cash flow. I don't want to. Let me just leave it at that. That'd be enough. I think I'm freak most of you out. It's not that bad. It's just information. I can't cover everything, but if we talk about it, I will pick out the items that if you finish this course, you know it. You'll have a good basic understanding. When you take the next level at another class, the higher level, or when you transfer to a 4-year university, and then you just keep on picking up when you finish your bachelor's or master's. We may use the same book. He's a well-known author. It's a real good book, International Management. This may be the same book you're using for your bachelor's, but you say, hey man, I had this. You're just exposed to this now. Then they're going to go more into depth in the formulas because you already had this here, and then your master's more into taking apart companies and actually looking, and your PhD at the whole level, coming up new ideas. What could I do, and what country would I work with? Okay, now chapter 11, managing transactions. Okay, hedging payables, when do I hedge? Buying the futures, hedging receivables, right? Limitations of hedging, alternative hedging techniques, and policies for hedging exposures, okay? Now, I see I got these all tied into the chapter, so I'll just leave it at this one, and it'll be better. Okay, managing economic exposure, translation, economic exposure, everything with hedging is, or futures, you can kind of look at that. I'm buying something, I'm hedging something now, taking that, I don't want to say gamble, calculated a risk going forward, but what's the economic exposure? Do I have to increase my my risk factor on that? So it may not be a very favorable thing to accomplish. Okay, and managing translation exposure. Boy, my tongue is really hard today. Okay, we only have a few more. Okay, we're almost done here. Okay, then the next one. Now we're going to go to chapters 13, 14. Okay, 13, direct foreign investments. I buy property there. Multinational capital budget. Again, here comes a budget. How do I budget? And, where do I get the finances? Like any kind of budget, what's my baseline? I have to budget going forward, but I'm budgeting for different companies, for different operations. And, chapter 60, country risk analysis. Which countries are at a higher risk? People are looking at Iraq going in there, but, with everything else, the turmoil there, with keeping the government on its own, working more multi cultural within that own culture, for lack of better words, different religion, different sects, different tribes, and everything else working together on that. So when I'm looking at that, what's the risk factor? How much money do I want to invest in there? How much investments do I want to go in there? I don't invest, but do I slide off a little bit? Do I watch myself? Because it could be a whole new different government, or the government, you could fall and you lose everything. So there's a risk, and how much? Or do I start taking the money out of there and moving someplace else at the neighboring countries that will still provide me the same exposure to that region and the same goods what I'm looking for? Okay, so I'm looking at that, and then I'm looking at multinational capital structure, the cost of capital, and we'll be using that on the web, and long-term debt financing. So on this one, direct foreign investment, We'll be talking about motives. Why do I want to invest overseas? Why do companies come over here? A lot of times we have manufacturing plants, auto, that are closed down because the domestic market, the capitalistic system basically say, hey, you're not effective, you're not productive enough, you're not efficient, so you close down, have all these sites. Now they're looking for, do I go Mexico, it's close by in here, or do I go into this here, have the full facilities, like an enterprise zone, international enterprise zone, that come, the states and the government, the U.S. government is helping you to bring jobs into this market, and it helps everything else. So I'm here for 5, 10, 20, maybe 10 years, but it's cost effective. After 10 years, I don't get the same credits or everything else. I may decide to move. An organization, when they come in there, manufacturing, 10 years is a good spot because of technology. They have to retool and everything else, so they'll move forward. Okay? And the host government's view of direct foreign investments. And then the next one is multinational capital budgeting. And in this one, subsidiaries versus parent perspective. Remember, the host country has an idea how they're going to do their own budget. As a corporate, I'm looking at a corporate at a higher level for the return for my investors. So there has to be a balance on there. Input for multinational capital budgeting. Multinational capital budgeting, there's an example in here. Other factors to consider, such as inflation, financing, blocked funds. You can't get uncertain salvage value depending on the country. Impact of projected prevailing cash flow. Exchange rate could change that. Your taxes, some kind of disruption in their financial market could lock my money in there, or change of government, whatever. Host incentives and real options. Okay. Now adjusting project mix for that. So that's what I'm going to be doing on the budget. Always adjust. I can't get rid of the risk, but how do I minimize it? That's where diversification comes in, even on international. Okay, Chapter 15, International Corporate Governances and Control. That's going to be more online. You'll be doing some research. International corporate governances, who are there? Corporate control, how do they control? Factors affecting target evaluation, what's the value of a certain asset? Examples of evaluation process, disparity in target valuation. Remember, it's kind of hard to get the real number depending on what's going on there, but you do your best, and there's companies out there, and it depends how transparent, but a lot of that, there's enough out there that individuals have a pretty good handle on what the value of certain areas are, and what are the value of the target valuations for my operation, my multinational company. Okay, other corporate control decisions and corporate decisions as real options. Okay, so 15, 16, country at risk, and I covered a little bit political risk, financial risk, measuring countries' risk. That's a factor you add on into your future value of your dollars or your investment, or is a risk. I don't want to invest in there. What's my return on my investment? It has to be higher. No different than the poor creditworthy, because I'm taking a risk. And if there's any kind of insurance, or what's the worst thing happen if I lose? What is the effect? I lost that asset there, but internationally, could I write that off as an expense or as a risk for something else, or could I be insured and to minimize my risk? Remember, you're looking just a little different in an organization that's looking at it just domestically. They got different markets, different potentials. How do I transfer some of my goods out here, close that one up, or expand in there, or take the risk, get a higher return, or get some concessions from the host countries, or from the other country, other multinationals, maybe selling some of their stocks and everything else. I'm just looking at diversify my own portfolio. Okay, but I have to look at the country. What are the laws? What's coming in there? What's acceptable? Okay, and that's one thing with China. When you look at some of the finance people are looking at it, they're hesitant because the Chinese government, not only that they're propping up, that's what the country should be doing, the government should be doing, but more is, how are they going to change the rules? Are they going to be more? It's going to be, I put my money, I can't get it in there, or they, so it's a risk. And so some are trying it, some are already in there, some are going to stand there, but sometimes if something goes wrong, they arrest them, put them in jail. We do that here in the U.S., but is the court system, or is the legal and regulatory favorable for my operation within that country? Remember, even though you have international standards, but you are still in that host country and have to follow the rules international if I want to do business with them. and to get access to their capital or for the finances and investments and vice versa. Okay, so we have that. The next one is Chapter 7, Multinational Capital Structure and Cost Capital. It's the web one. What do they have on there? Okay, let me see here. There's subsidiaries. You're getting, oh my God, will he finish? Look, there's a lot. So you have a general idea. You'll know what's going on. Multinational cost of capital across the country. You're looking more at conceptuals. I'm looking more at strategy. I'm looking more at you understanding what the terminology means at this level of the class. Okay? Your the quizzes and everything else would be appropriately put in there. You'll do very well. You'll do a paper. You'll do the quizzes. It'll be times not all at once, so it'll be within a shorter time period. So I think that's what I do instead of final and everything else. I'm thinking in my mind. I've done this before. In my finance classes, I'm doing in this one. How do I make it manageable? Because you're learning a whole new language. You've already had the domestic language. Now you're learning a foreign language. What do you call it? International finance. Okay. Now, long-term debt financing. That's going to be an online exercises. Financing to match the inflow of currency coming in. Debt dominations. Decisions by subsidiaries. What's the transfer rate? How do I break it up? The currency. Debt maturity decisions. When I pull in the debt, when I turn it over, or when do I convert it, if there's a conversion factor that you've learned in accounting and in finance, fixed versus floating debt decision. Okay? So that took care of 18. Now we're doing, okay, so this basically was your long term. Remember, we did international, we did exchange rate, currency, exchange rate risk management, how do I manage this? Now we're looking at long-term assets, investments, and liability. Okay, the next one is short-term assets and management liability. We're going to be looking at Chapter 19, Financing International Trade. Let's just go this way. And so I'm looking at how do I finance your payment methods for international trade. We'll pick up on this, different payment, letter of credit, draft, consignment, open account. You've already been exposed to that in finance. Remember, because you're doing a little trading in there, a little international, or even within letters of credit, a consignment. That's everything else is doing domestically, the same functionality. Now, what are the rules for doing internationally? You'll trade finance methods. We'll talk about factoring. You do it here. You've learned that domestically. How do I do it international? Letters of credit, bankers acceptance, working capital. Counterfeit. You just counterfeit everywhere. Counter trade. What like a counter trade is the currency may be weak, and how do I do some other creative financial instruments or contractual agreements to exchange currency or whatever. Okay? Global trade, for lack of a better word. Okay, agencies that motivate international trade, and you're going to have, Export Bank of U.S., you got Private Export Funding Corporation. We'll have some linkage. You'll be doing some research in there. Overseas Private Investment Corporations. Okay? Okay, and then 20, short-term financing. How do I do short-term? Sources of foreign financing. There's a lot, internal, external, access to funding during credit crisis, financing of a foreign country, comparison of interest rates among currencies, determine the effect of financing rate, which is the better, where I keep the money. I need to keep the operation going, but do I, my profits, I pull it out so I can make a higher return. Look, I'm a multinational organization. I have stockholders. I have owners, and the job of the finance manager. I'm learning this class. Or if I'm a small business working up going to the international market, so I understand what are my options. Okay? I'm going to get in there as I grow. My operation is growing. It makes sense. I'm close to Mexico. I'm close to Canada, or have friends in the European Union. I could already make connections at the college, and I'm trying to sell or buy there. Okay, criteria for considered in financing decisions. Interest parity, a forward rate as a forecast, and exchange rate, and we'll talk about that. Actual results from foreign finances, you have to look that up or research. Depending on the country, there's a lot of countries out there where you'll select one country you're going to be doing a multinational project or term paper, looking at one country, and once you understand one country internationally, the concepts will fall in. The math will figure out for that country, but the concepts and ideas. You understand now. I understand what they're doing. I understand how international. I understand what this is called. Here's how I get a loan. Here's how I do sell my stock. Here's how I buy my inventory. Or here's how I open up a warehouse or open up manufacturing here. But I'm making profit here. Do I keep all the money there or do I move it back? And when do I move it back? Okay, chapter 21, International Cash Management. I already talked about that. Multinational Working Capital Management, Centralized Cash Management, accommodating cash shortages, for the organization, for a multinational, techniques to optimize cash flows within the multinational structure, different units or different geographic, depending on how your organization is structured, complications in optimizing cash flow, related government restriction, characteristic of banking restrictions, depending which area, which banking system. Remember, we got the Federal Reserve, we call it our bank, but there's like a equivalent of the Federal Reserve in different banks. I mean, in different countries that you have to, you could buy securities or buy their bonds, just like they could buy ours. Just like China buys a lot of our U.S. Bonds. They're probably the biggest holder. And they are the biggest holder, if I'm mistaken. Okay, investing in cash flow, determine effective yield when I cash it in. Implication of interest rate parity. What's the difference when I bring the money in? Parity and exchange rate tie in together. Use a forward rate as a forecast, exchange rate. Diversifying cash across different currencies. Dynamic hedging. Okay, so I took care of chapter 21. We'll have that. And what else do I have on here? Just different appendices. But I use some of them, answer self-question. Some of the appendices you have available to you. Supplemental cases using Excel to conduct analysis online. You need the link. And I don't think it's that expensive. New book. You get the passcode. Here, you could ask at the college how much does I need the link for in here. And I might be able to give you some of the outlines, Excel, but if I'm looking at real numbers, you have to actually go through their link. An investing project, it depends. If this is a summer class, 8 weeks, maybe not. 16 weeks, you have a little more time, glossary and everything else. All right, so what do you think? Now you know what you're getting into. Look, it's a lot of information. It's not bad. It's no different than your corporate finance. No different than accounting. Look, if you look at all the terms, everything else. I'm just bringing it up to you're going to be exposed to this. You already have a lot of that knowledge already from your corporate finance or introduction to finance, whether you've taken it at the community college or if you've taken it at a 4-year and you need this class to what do you call it for your degree or it's transferable. So here's the information. All right. So we'll cover the environment with exchange rate, the risk management, long-term management, short-term management. That's all finance is. Only now you're doing it internationally, and there's a few more different concepts and definitions you have to pick up. 21 chapters. The book is easy. I'll do it to YouTube. The concept maps are available. You'll be able to read, look at the concept maps, add on to them. The quizzes will help you, and they got other sites that I will make sure you succeed. All right. So my name is Dr. George Machaki. This is International Finance. This is an overview to a course you're taking me at a community college, and we'll see you. Get the book. Now you know what you're going to be learning. I mean, it's not going to be easy, but it'll be very manageable. I'll make sure it's manageable, and you'll be able to learn this. And then when you take it again, in a 4-year, most likely the same book, you take it to the next level. Remember, when you've taken algebra, you learn real quickly. You've taken accounting 1 and 2, then you went to finance, and each time you've learned the same concepts or words, and now it made more sense. And now you're just adding on to what you already learned, and then you have a good, solid foundation. All community colleges will give you a good, solid foundation. And then when you go to your bachelor's or your master's, you start doing more of the math, more expanding that foundation into critical thinking and how do I adjust. All right? So we'll see you. We got 19 chapters. Each chapter is very manageable. You got the quizzes. You got the help. The book's real good. You do very well. Okay? So I'll see you in chapter 1 or back in the classroom or in our, if it's mostly for, you're looking at this for an online, so I'll see you in the forums. But if you're looking at this as a supplement, because I leave that available for students also to look at, or you pick me up on the YouTube, sign up for the course at the college. I'm teaching this one at Harvard College in, what do you call it? In Cook County, Illinois. All right? Palatine, Illinois is Cook County. All right. So I'll see you in a few minutes. I'll see you online or in the classroom in a little while.